Welcome to the Provost Luncheon for the winter quarter. It's very great to see how packed the room is. Thanks so much for attending. Before we get into it, there'll be a few paid advertisements by the Provost office to launch us off. So watch for the invite because there will be a third Provost Luncheon in the spring, and we will be honored to celebrate the university lecturer, Lynn Baker. And so that will be a wonderful event, and please look for that in your emails as it comes out. This Thursday, for the faculty in the room, there's the Provost reception. It'll be in the Kvetstad room, the special events room in AAC from 4 to 6. We will be partnering with Faculty Senate to host a town hall on the coach data, where we are currently, what we've done as a result of it, and where we look to go in the future. Then this Friday, just to remind everybody, everybody's invited, is the Provost Conference, which is a collaboration with all the governance groups on campus to host a summit on shared governance. We have two phenomenal external speakers who will be in attendance. Both of them will be helping us think about how to leverage our shared governance in order to build a greater university and community, but also how to use those governing bodies in times of change. There is a special session on Friday, late in the day, and I want to make everybody sure that they're aware of it. It is a session around how we can create a culture of caring. How can we eliminate gender-based violence on this campus and maybe beyond the campus? All those sign-ups are available online if you just look for the Provost Conference or you type in the Summit on Shared Governance. So let's get on to what we're really here today to celebrate our newest distinguished university professor. And so to make the introductions, I'm going to turn it over to Dean of the Korbel School. I just forgot the building I was in at the moment, Fritz Meyer, and he will do the introductions. But this is a wonderful, wonderful opportunity. We just started this last year, where the individuals that receive the Distinguished University Professorship talk about their research and share it with the community. In past, we have not been good about celebrating and sharing their deep and rich career around their research and scholarship. Fritz.
Well, what a great pleasure to welcome you to the Korbel School, and even greater pleasure and privilege for me to introduce our colleague, Eileen Grable, who is the newest Distinguished University Professor here at the Joseph Korbel School. What to say about Eileen? She's sort of a trifecta. She's an extraordinary scholar, an absolutely wonderful teacher, and a really engaged intellectual. And certainly richly deserving of this honor. First, what a fabulous record of scholarship. She really is one of the world's leading scholars on global finance. She's published widely on financial policy and crises, developmental financial architectures, international financial institutions, international capital flows, global financial governance. But all of this is about making the inscrutable but important world of development finance legible. Her recent book, When Things Don't Fall Apart, Global Financial Governance and Development Finance in an Age of Productive Incoherence, which is a mouthful, won a number of awards, including the 2019 European Association of Evolutionary Political Economy Myrdal Prize, the 2019 International Studies Association International Political Economy Best Book Award, the 2018 British International Studies Association International Political Economy Book Prize. You get the picture. It's been incredibly well received. Her previous book with Ha-Joon Chang, Reclaiming Development, has, since its publication in 2004, really helped to reframe the debate about the role of the neoliberal paradigm in development economics. And it's really become a classic in the field, translated into multiple languages. And in addition to her books, she has published articles in World Development, Journal of Development Studies, Review of International Political Economy, International Journal of Political Economy, Cambridge Journal of Economics, and on and on. It is really quite an extraordinary record. But Eileen is not just a great scholar. She is just an absolutely wonderful teacher and mentor. As a student seated at this table can attest, at the Corbell School, she co-directs our MA program in Global Finance, Trade, and Economic Integration, known as GIFTY. The students just love her. Her reviews are extraordinary. And everywhere I go, when I meet with alumni, somebody says, Professor Grable really made a difference. She was great. I was just in Washington last week having breakfast with students, and several of them commented, Eileen, about how important you were to their life at Corbell. And I was out at NREL the other day, and one of your former students said, "Oh, say hi to Eileen." So I'm doing that now. But wait, there's more. She is sort of the model of an engaged intellectual. Eileen serves on the Intergovernmental Expert Group on Financing for Development at UNCTAD, United Nations Conference on Trade and Development. She's worked with the Human Development Office at UNDP. She's worked for the the United Nations University, World Institute for Development Economics Research, and on. Third World Network. She's just so plugged in, advising the IMF. She is incredibly plugged into the policy world, and really someone that people around the world turn to for advice on these complicated issues. Really an extraordinary record. One more thing, if that were not enough, in another life, Eileen was a professional chef, and she's a wonderful cook. So it's really quite daunting, in a way, to look at her record. But more than that, Eileen is a wonderful colleague and truly a great role model for all of us. Eileen Grable.
Thank you so much for being here. I really appreciate seeing so many friends and colleagues. I want to thank Corinne for inviting me to talk about my work, and I also want to thank Fritz for his very generous introduction. I want to also thank my Corbell colleagues and students for their support and friendship over many years. And again, thanks to all of you for coming to hear me talk about a topic that I think can feel arcane and perhaps even boring. And I think, as you can tell from the Meant to Provoke title of my talk, I worked on that title for a long time, I hope to convince you that global finance is not actually boring at all. So let me just begin with some controversial claims. The first controversial claim that I want to make is that there's one thing about which we can feel good right now. And that might not strike you as that much of a provocation, but I do want to remind those of you that are not economists that economics identifies itself as the dismal science, so we rarely find anything to celebrate at all. And while I'm at it, I want to mention a few other provocations as well. One is that President Trump's actions are hastening the end of the American financial order, an order that was already unraveling for a variety of reasons before he took office. My other provocation is that the unraveling of the American financial order is less worrisome than you might think. And indeed, it's mostly a good thing from the perspective of the developing world and in terms of the resilience of the global financial system. Now, before I try to sell you on those controversial arguments, let me just clarify something, and that is, what do I mean by a global financial order? The global financial order has many components. It's comprised of financial institutions, such as the International Monetary Fund, which is called the IMF, and the World Bank. It's also comprised of monetary and financial policies in place around the world. It's also comprised of networks of policymakers and regulators, such as central bankers and finance ministers. It's comprised of financial flows, such as international loans, investments, and foreign aid. And it's also comprised of the set of ideas that shape practices in the financial realm, such as those concerning how finance should be managed. There have been two distinct American-led financial orders. The first American-led financial order was created in the ashes of World War II at a conference of the war's allied powers. This is the famous Bretton Woods Conference of 1944. This first order was marked by a unipolar global financial architecture and wide consensus around Keynesian principles of economic management. Now, Keynesianism meant many things, but chief among them was the view that the state should play a central role as an economic actor and that financial flows should be managed so as to protect the economy from external disruptions and so that it supports industrial and employment priorities. The financial order that was built around this vision had a coherent, streamlined, centripetal character. The U.S. Federal Reserve became the de facto world central bank, the dollar the world's currency, and the IMF and the World Bank, which together are known as the Bretton Woods institutions, became the most influential multilateral financial institutions in the world. Now, the first American financial order achieved a great deal. Chief achievements include the restoration of prosperity and economic stability in Europe and Japan, rebuilding infrastructures that were destroyed during the war, and the sustenance of conditions that promoted capitalism, democracy in some, but not all parts of the world, and the containment of pressures that might otherwise have led to a resurgence of fascism and communist expansionism. The first order gradually began to unravel in the late 1960s and the early 1970s under the weight of economic and political pressures and ideological changes. The 1970s through the early 2000s comprise the second American financial order. It was no less ambitious than the first order. The second order is the one that you might associate with US President Reagan and British Prime Minister Margaret Thatcher, though the lifespan of the second order actually both precedes and follows these administrations. The second order is commonly known as the neoliberal era. The second order featured finance untethered, dominant, and globally integrated. It celebrated the role of markets and trade and investment agreements in disciplining governments, and it promoted the convergence of economies around US policy and regulatory norms through a range of internal and external channels. The neoliberalism of the second order reinforced US-led financial unipolarity in ways that amplified the role and the power of the Bretton Woods institutions and those of US financial interests. Now, with some exceptions, this order reflected and promoted the primacy of liberalized, liquid American financial markets and the American financial model as a global ideal. As with the first order, the second order has some notable achievements, the most important of which was the provision of financial support for the transition to capitalism in the former Soviet states. Other outcomes of the second financial order are less worthy of celebration. Indeed, neoliberalism has an ambiguous, pyrrhic, and deeply problematic legacy. Rampant inequality is one legacy of the second order. Another legacy is severe, cross-nationally contagious financial crises in the developing world during the 1990s through 2001. And these financial crises actually expose fault lines in the second order. These crises, especially the East Asian financial crisis of 1997 to 1998, are very important to the story that I'm telling today because they mark the beginning of the end of the second American financial order. These crises opened cracks in the neoliberal consensus because neither the IMF nor the economics profession could remain impervious to the recurrent crises of untethered finance or to the achievements of financial practices in those countries that flouted neoliberal prescriptions during the second era, and there were some. The East Asian crisis was ultimately costly to the IMF, since the economic pain and the political intrusions associated with its response to the East Asian crisis had very important behavioral effects on policymakers throughout the developing world. It led policymakers throughout the developing world to stockpile savings, which are called currency reserves, in order to reduce the possibility that they would ever have to turn to the IMF for assistance again. Most observers came to see the IMF as irrelevant, particularly after its customer base collapsed once the Asian crisis loans were repaid. The Asian crisis had other effects as well. It renewed interest on the part of developing country policymakers in the creation of institutions that could supplement and in some cases substitute for the Bretton Woods institutions. And finally, the Asian and other crises of the 1990s induced policymakers to create informal financial governance networks that brought together finance officials from wealthy countries to provide oversight and to coordinate across an increasingly complex global financial terrain. Now, in the last decade, these informal financial governance networks broadened their membership so that they now include developing country policymakers as well. Now, the crises of the 1990s, and especially the global financial crisis that began in 2008, threatened not just the predominant economic model, which was the neoliberal model, but it also threatened the unipolar character of the global financial order. In my view, the global financial crisis ultimately had contradictory effects on the global financial order and neoliberalism, deepening fissures in the US-led regime, while in some ways also reinforcing the US's central role. Now, before leaving this account of financial orders, I just want to note that for reasons of time and for reasons of clarity, I gloss over nuances, contestations, and departures that did obtain during the first and the second financial orders. Okay, so where does all of this leave us? I think the best that could be said is that we're in a period between periods, an interregnum, if you will, in which there's no coherent singular ism or set of competing systems of economic arrangements. Instead, what we confront now is the simultaneous proliferation of regimes that include kleptocratic capitalism, state capitalism, social democratic multilateralism, neoliberal nationalism, neo-nationalism, and what I call embedded populism. A large range of actors and institutions have joined the conversation in global economic governance, pushing forward with ambitious new initiatives. Many of these initiatives are encouraging, while others are not. Some of these initiatives are serving as spoilers. Others are mimicking practices pioneered by established actors and institutions, while others are establishing new networks that are beyond the direct control of established institutions. And so we confront the 2020s anxious about the shape of what is emerging and about what is to come. A post-American, post-neoliberal order may emerge, but it's difficult at the present time to see where the seeds of a new order lie. Most observers see this kind of aperture only as problematic. I view things differently. If this period of aperture has one dominant feature, it's that it is incoherent. And by incoherent, what I mean is that the landscape of international economic governance, especially in finance, features fragmentation, conflict, experimentation, proliferation, and unevenness. In short, there is no ism. Instead, what we have is a proliferation of conflicting norms and strategies and a profound nostalgia for the tidiness of the first and the second orders, even among their critics, because the playbook seemed clearer at that time. Now, I know that it's difficult to find much to celebrate in this kind of precarious situation. There are clearly significant risks emanating from the destructive aspects of today's incoherence. Financial fragilities are, of course, pervasive right now. Post-war cooperative traditions and institutions of multilateralism are under assault, and where they're not under assault, they're being hollowed out. During and since the global crisis, central banks have exhausted their arsenals, while a trade war between the US and China is recruiting current central banks into currency wars not of their own choosing. The Federal Reserve faces populist resentment mobilized by the president. Domestic and international politics have turned inward and nasty in many contexts. And this counter-movement has many roots, among the most important of which are the real and the perceived damages associated with the creation of a coherent, internationally integrated system under the banners of neoliberalism and elite-led cosmopolitanism. Progressive and retrograde deglobalization impulses have undermined the prospects of regional and international cooperation, especially as concerns the provision of public goods and the protection of the global commons. These developments jeopardize essential international projects, such as the United Nations Sustainable Development Goals, which are called the SDGs, and the prospects of a New Deal, while substantially weakening collective responses to challenges in the global commons, such as the refugee, the climate, and public health crises. The prospects for truly global coordination in response to future financial crises are, in a word, dim. So without denying or downplaying the risks that I've just enumerated, because you might feel a little depressed at this point, I want to suggest that today's incoherence also includes productive moments. Incoherent changes are creating what we might think of as exits or leakages from a noxious national and global policy environment, rendering it somewhat less poisonous than it would be in the absence of intellectual aperture and contestation, and in the absence of competing policies, institutions, networks, and poles of power. I'd also like to convince you that recent developments in global finance have rendered Trump's impact on the developing world and on global financial resilience less severe than they would have been in the heyday of the American financial order. And let me now sketch out for you why I think you should at least be cautiously optimistic about the global financial landscape. One positive outcome of the global financial crisis is that it undermined the financial monoculture that marked the second financial order. In fact, the global financial crisis deeply tarnished claims for the superiority and the universality of the US financial model. The crisis validated the views of critics of the model in the US, China, and elsewhere, who had long identified the failings of light-touch financial regulation by regulators who had deep ties to the financial industry. The crisis also made clear that the US-based credit rating industry relied on flawed risk assessment models and fundamental conflicts of interest. The crisis shook some of the most ardent champions of the US financial model, reaching no less than former Federal Reserve Chair Alan Greenspan, whose awakening came early in the global crisis and after he left the Federal Reserve. Developing country policymakers exploited the crisis and the post-crisis environment to call for alternatives to a US financial order. This call came most explicitly and most regularly from Chinese officials, though others also made similar calls. Indeed, The Economist magazine recently identified what it sees as the new age of international monetary experimentation, which comprises numerous early-stage innovations and blue-sky discussions among US friends and foes. These initiatives seek to gradually reduce dependence on the dollar and to provide protection from the weaponization of the dollar, the weaponization of the financial system, and the weaponization of international trade. This has become especially appealing as the Trump administration has grown increasingly committed to intensifying and diversifying the channels through which financial and economic relations are being weaponized. At the annual Jackson Hole Forum for the World's Central Bankers, the former governor of England's central bank, Mark Carney, argued that the world's reliance on the dollar won't hold, and he proposed at that meeting that the IMF take charge of a multipolar system of currencies, including a global electronic synthetic currency that would entail a network of central bank digital currencies. The trade and the currency wars unleashed by the Trump administration are providing additional momentum to the case against the U.S. financial model and against U.S. economic leadership more broadly. The erratic nationalism of the Trump administration has widened the void in global economic governance. And I should note that that was a void that was first opened by the Obama administration's refusal to accept China's invitation to join the new Asian Infrastructure Investment Bank as a founding member in 2015. Now, the point that I'm making is that the end of the hegemony of the U.S. model has created space for a pluriculture of hybridized rather than ism-driven financial models. China's model is the most legible of these alternatives, but there are other inchoate initiatives in South Korean, Indian, Malaysian, Brazilian, and Islamic finance, which represent alternative modes of organizing finance. The bottom line here is that just as in agriculture, pluricultures are more resilient than our monocultures. Now, a second cause for cautious optimism, in my view, has to do with central banks. Thanks to the global crisis and other developments since the crisis, central banks have a broader set of tools, objectives, and relationships. During the global crisis, it became normal for central banks to pursue what became known as unconventional monetary policies. Examples of unconventional monetary policies include negative interest rate policies and policies of quantitative easing, and programs to essentially open lines of credit with one another. At the same time, central banks began to target a much broader range of policy objectives. Traditionally, central banks focused on reducing inflation as their key priority. During and since the crisis, they've also targeted speculative bubbles and currency misalignments. Moreover, central banks are increasingly emphasizing the importance of developing new tools to green monetary policy. The goal is to use monetary policy to support a transition to a low-carbon economy and to build climate risk assessments into lending decisions. The IMF's new managing director, Kristalina Georgieva, is also placing climate risk assessment at the centerpiece of the institution's lending programs. Now, before leaving the world of central banks, it bears mention that central banks are operating in what can only be described as a weird environment. The novel environment in which central banks are operating involves attacks on their credibility and performance and threats to their independence. Turkish President Erdogan in 2019 was able to do what President Trump has threatened many times but has been unable to do, and that is to fire a central bank chair that was unwilling to bend to his will. The attack on central banks has placed them on the defensive in many contexts. This situation, I think, coupled with recent economic volatility, may at least partly explain why the Fed and the European Central Bank recently moved back toward accommodative monetary policies. And notwithstanding the hostility that I mentioned, leadership of the world's most important central banks, from the US to China to Europe to the UK, Japan, and Mexico, have commendably remained above the political fray. Now, another cause for optimism is given by the way that the global crisis helped to destigmatize an important tool of financial policy, which is called a capital control. Capital controls are policies that manage and sometimes slow international movements of money. This policy fell out of favor during the second financial order when unregulated financial flows were idealized. Capital controls were central to the financial stability that marked the first American order. As the global crisis emerged, capital controls were resurrected by central banks and finance ministries. They were used successfully by a large, diverse set of countries facing very different kinds of economic conditions. They are now seen by central banks, by finance ministries, by the IMF, and even by the credit rating agencies as legitimate parts of the policy toolkit. Recent experiences with these policies may prove important during the next crisis. Now, the current situation of the Bretton Woods institutions warrants mentions as well. That's a kind of complicated story. The Bretton Woods institutions face hostility from the US, their primary sponsor over the long post-World War II period. President Trump's Treasury team and his appointments to both the IMF and the World Bank display the administration's deep hostility to multilateral organizations and its hope to weaken the institutions from within. Now, the Trump attack is intended to hollow out the Bretton Woods institutions, in part to deny China and other developing countries competitors, to deny them the opportunity to have a foothold and to extend their role in global economic affairs. I think that's the kind of rationale for this strategy. The Trump strategy of hollowing out these institutions is, in my view, short-sighted and likely to fail. Indeed, developing countries have stepped into the void created by US reticence by lending money to the Bretton Woods institutions twice during the global crisis, by maneuvering efficaciously with them, and they have taken on much more influential roles at both of these institutions. I do want to emphasize that the IMF in particular has a crucial role to play in times of financial crisis. The managing director of the IMF, Kristalina Georgieva, is extraordinarily competent and formidable. She and the institution's staff have essential expertise that may soon be called upon if financial volatility increases. I do hope that the imminent appointment to the IMF's open number 2 position does not inhibit its ability to respond to future crises. There's also something very encouraging in the way that the global crisis catalyzed construction of a much more densely populated institutional landscape, something that was already threatening the privileged place of the US even before Trump's election. And what I mean by this is that the global crisis occasioned the creation of new financial institutions financed, helmed, and based in the developing world. Older, smaller-scale institutions based in the developing world were also scaled up during the global crisis. Some of these institutions are in the Eurasian region, others are in Latin America, others are collective efforts by Brazil, Russia, India, China, and South Africa, what's usually referred to as the BRICS group, and others have China as a key driver. These institutions are networked with one another and with the International Monetary Fund. This increased architectural density and pluripolarity has the potential to increase robustness and anti-fragility in the global financial system. The last facet of incoherence that I want to mention involves conflicting trends pointing toward deglobalization, reglobalization, and new multilateralisms. During the first and the second American-led financial orders, lending by the Bretton Woods institutions amplified and transmitted policy norms and reinforced the U.S.'s central role in global finance. Today, China's international lending, aid, and investment programs reinforce the country's new role in reshaping the global financial landscape. Outstanding international loans by China went from approximately 0 in 2000 to more than $700 billion today. China is the world's largest official creditor, more than twice as big as the World Bank and the IMF combined. Many observers have compared China's Belt and Road Initiative to the U.S.'s Marshall Plan that followed World War II. But I think it's important to note that 90% of Marshall Plan funding involved foreign aid, not loans. The money for the Marshall Plan came from the U.S. government, whereas the Belt and Road comes from a variety of sources, including profit-seeking private entities. The Marshall Plan gave liberal, that is, liberalized markets a decisive role, whereas the Belt and Road does not. During the global crisis, the Chinese government positioned itself as a savior of multilateralism. The government also signaled its commitment to multilateralism and to Chinese-led reglobalization during the crisis by launching a number of initiatives, such as the Asian Infrastructure Investment Bank, the Belt and Road Initiative, and a range of other loan and aid programs. I'll also note that China has been working on developing an alternative to the West's dominant financial messaging system, which is called the SWIFT system, and it has been supporting the internationalization of its currency through a variety of initiatives. Chinese President Xi launched a very robust defense of globalization and multilateralism at the World Economic Forum in Davos in January 2017. Since then, Chinese officials have seized the stage on many occasions to defend multilateralism and the benefits of global economic integration, often speaking of the constructive role of the BRICS group. Now, many observers worry about the kind of reglobalization and multilateralism that is emerging as China steps into the void created by the fracturing of post-war traditions of multilateralism and the rise of illiberal nationalisms. Others raise concerns about the construction of a parallel system at a time of U.S. retreat and at a time of expanding global demand for infrastructure finance. More immediate concerns raised by China's lending include financial fragility induced by its overlending, influence over borrowers and control over natural resources, and the damaging carbon footprint of its loans. But we have to be aware that China is not the only actor promoting reglobalization and new multilateralisms. Indeed, there's substantial support for an unspecified but presumably modernized, heterogeneous, and permissive liberal multilateralism coming from other quarters. For example, French, Canadian, and German heads of state, the leadership of the IMF as well, are all promoting multilateralism, a kind of modernized multilateralism. In addition, a group that's come to be known as the Democracy 10, which involves senior officials from the world's leading democracies. This group has been meeting for the past 4 years to discuss how to coordinate strategies to advance the liberal world order. The chief inference to be drawn at this point, I think, is that the shape of multilateralism and economic integration are being contested and reshaped right now. The most likely outcome in the near and medium term involves deglobalization, reglobalization, and a variety of multilateralisms against the backdrop of illiberal nationalisms. Now, circling back to the title of my talk, I want to revisit my argument that the changes and the openings that I outlined are mostly encouraging. From my perspective, recent crises should be understood as crucial turning points in a contested, uneven, long-term process of pragmatic adjustment in the global financial system. A non-coherent system is better apt to protect the space for heterogeneity and experimentation. After decades of stultifying coherence, the space provided by incoherence, I think, is a welcome deviation. In my view, one advantage of incoherence and pluripolarity is that it provides developing countries with a degree of insulation from the global spillover effects of a noxious policy environment. After all, an unintended consequence of a coherent, centralized financial architecture is that structural weaknesses are magnified and negative spillovers can be more powerfully and directly transmitted across countries and regions. I think incoherence presents other opportunities as well. A densely populated institutional landscape expands opportunities for problem solving, experimentation, learning by doing, and learning from others. It also creates opportunities for the creation of partnerships, networks, and coalitions. It creates opportunities for forum shopping that can be of particular benefit to smaller countries. A more densely populated financial landscape increases the availability of long-term loans that are connected to the UN Sustainable Development Goals and provides the opportunities for increased resources for crisis support that fill gaps in the global financial architecture. Finally, there is some evidence that the performance and the responsiveness of the Bretton Woods institutions is improving owing to the competition that they now confront. So that's the upside, and I obviously claim that it's substantial, but we do have to recognize that incoherence, redundancy, and pluripolarity also entail important risks, as I noted earlier. Incoherence can also be destructive. The currency and the trade wars that are now unfolding are examples of destructive incoherence. Incoherence can also be destructive if it creates uncertainties about where responsibility lies in a crisis, or if there's conflict around the rules of engagement and around leadership in times of crisis. None of the risks that I've mentioned are unique to the emerging incoherent world, but neither are they resolved by it. Now, notwithstanding these risks, I think it's naive to think that we should be nostalgic for the coherence of the first or the second American-led financial orders and the monolithic governance architecture that underpin them. After all, would it be better for developing countries if the Trump administration had at its disposal a streamlined global financial order through which it could leverage its power to constrain policy autonomy, frustrate the Sustainable Development Goals, and otherwise wreak havoc or play out petty grudges? As damaging as Trump's impact has been so far, and the worst may be yet to come, I think it's at least arguable that he lacks the levers under the evolving global financial architecture to impose his vision on others, at least with the same degree of success that was enjoyed by the champions of neoliberalism during the Second Order. A Trump in, say, the late 1990s, at the height of neoliberalism's coherence and at the height of its power, would arguably have posed a much deeper threat to developing countries. Moreover, it's implausible to think that the aspirations of developing countries would be better served by a return to the institutionally sparse, coherent, and centripetal financial and intellectual architecture of the last many decades. It's best, I think, to consider the present as an interregnum between an era that was dominated by a dysfunctional financial monoculture and something else, the parameters of which are as yet unknown and unknowable. The evolving landscape, I think, is not likely to meld into a new, coherent global financial architecture that resembles the kind of orderliness of the pre-global financial crisis world. The array of China-led institutions is complementing, competing, radically reshaping, and above all, complicating the global financial landscape, where the line between wealthy country lending and developing country borrowing used to be clearly drawn, but is no longer clearly drawn. The vacuum that was created by the US's recent rejection of multilateralism suggests that there'll be greater space and more urgent need for China and others to step into the void created by US reticence. And this, of course, presents opportunities, but we also have to recognize it also presents real risks for developing countries. It also presents real risks for US power and for the shape of multilateralism going forward. Engineers understand the need for redundancy in safety systems in order to ensure that systems do well when placed under intense stress. In my view, the increasingly dense and increasingly networked global financial architecture is prudent in the same way, even if it is by no means adequate in its current form to maintain stability during the next financial crisis, the timing of which is uncertain, though its eventuality is not uncertain. And so nothing that I've said should be taken to suggest that I think things won't fall apart. Indeed, they can, and they always will. But when they do, the question is, will a messier, more pluripolar, more network global financial architecture be better situated to respond to the needs of developing economies and to outbreaks of financial instability in a world in which the Trump administration is unlikely to have an appetite to allow the Bretton Woods institutions to perform their traditional roles? Present conditions suggest that we may know the answer to this question sooner rather than later. And I'll end there. Thank you. Thank you all for your patience. Taking some questions? Oh, you're very welcome. Should I step down
No.
to take questions?
No, no.
Oh, okay. I
No,
didn't know.
no.
If the questions
We
were
have time for some
answered. Good,
questions.
good. No, I thought the mic
Everybody
fell.
heads hurt now?
Great.
Everybody's head hurt?
Okay.
Eileen, thank you so much. I mean, it's a wonderful analysis, very eloquently
Thank you.
given to us. And I want to pick up on one kind of question. Underneath the financial architecture, at least two clusters or domains of forces. One is more or less political economy, the rise of the emerging states, and particularly China, changing patterns of relationship after the Cold War and so on. And you've spent quite a bit of time explaining how those forces have given rise to this incoherence and to the changing patterns of the architecture. Over here, you've got a second cluster, which is basically the changing nature of the economies in interaction with technological change. And those are having a lot of impacts also on the way the economy of the globe is structured, the way actors interact with each other. I mean, for one thing, the growth of technology driving down prices in a lot of areas is related, obviously, to the financial patterns, the negative interest rates, the kind of breakdown of the Phillips curve relationship between inflation and interest rates. I'm wondering if you could say just a little bit more about your thinking on this second cluster, the changing nature of the economy as we move to the digital age-driven economy, the relationships that it causes with prices and well-being measures. I mean, GDP not being so useful anymore. I mean, how does this shape? You didn't mention cyber economy, cyber currencies, for instance, and their potential challenge to the architecture. Could you say a little bit more about this second cluster, this technological economic cluster, in juxtaposition to the political economy cluster?
Okay, sure. That's a lot of macroeconomics, so I'll try to just focus in on a few issues, but thank you, Barry. Where to cut into that. In terms of technology, technology obviously is having myriad effects in terms of reshaping economic relations and economic governance, and it's also become an important locus of economic power. And indeed, when I mentioned just briefly the weaponization of financial and economic relations, I was sort of alluding a bit to this issue of the impact of technology on economic relations and economic power. Kind of to just unpack that a little bit, the way in which financial relations are connected to one another at this point does open both opportunities and challenges in the global financial architecture. To take a kind of concrete example, many people describe a network. It's called a financial messaging network. I think I referred to it. It's the SWIFT network, which is a kind of long acronym. It's essentially the kind of arteries of the international financial system. It's where payments are messaged and transferred. So it's a message network. The U.S. plays a really central role in the SWIFT network. Recently, the SWIFT network has become weaponized. What do I mean by that? The Treasury Department under the Trump administration has developed a real appetite for using economic sanctions as a kind of new tool of warfare. And they have used the SWIFT network, I think, very effectively in that way, essentially threatening countries that do business with U.S. foes to have transfers that are made through the SWIFT network ceased. And so it's a way of kind of threatening, sanctions against countries that are doing business with Iran, for example. And that's become a really important tool of foreign policy. The U.S. Treasury Department has actually 30 different sanctions programs against 30 different countries in place at the present time. That is a very powerful way that technology allows the Trump administration to leverage power to control global financial flows as a way of kind of punishing or rewarding countries. However, I'd say that the story is a little bit more complicated because the use of the SWIFT network in this way has also stimulated other actors like China to develop an alternative to the SWIFT network, which there's a lot of acronyms in international finance. It's called the CIPS network, CIPS. It's a Chinese-led financial messaging application. It is not being used on a large scale at the present time. Indeed, it's being used on a very small scale, but the Chinese central bank has great ambitions for the CIPS network, and many other countries are now discussing with China connecting with CIPS because they're well aware that SWIFT could actually freeze financial flows to them in ways that they would find problematic. There are also other countries that are developing alternatives to SWIFT. So what's the point? Technology provides a mechanism for control in the financial system, but the kind of horizontal nature of technology, that is to say that these innovations are available to many actors, also is part of this story of incoherence in the global financial system. So I think we could see it as a kind of double-edged sword. One other sort of point that I guess I would want to make about technologies, not to belabor the point, you mentioned cyber currencies or cryptocurrencies, which I mentioned only in passing in connection with a proposal by a very respectable actor, the former governor of the Bank of England, Mark Carney, who shortly before he stepped down from his role a few months ago, has made some really well-publicized proposals for the creation not of cryptocurrencies, because those are not linked to governments, but rather to the creation of digital currencies among a network of global central banks. And so in that sense, I think that's part of the way in which many actors, again, friends and also foes of the U.S., are looking at technology as something that can be weaponized, but also as something that can protect themselves from the weaponization of finance and economics. So more to be said about that issue. And I know your other point was about the kind of secular stagnation thesis, which is, I think, probably what you had in mind in that comment. And yes, there's downward pressure for those here not so interested in the technicalities of debates among macroeconomists. There's downward pressure on prices in the world, such that what central banks are now worried about is deflation and not inflation, which had traditionally been their foe. And that, of course, has really important implications for aggregate demand at the global level. If prices are stagnant or falling, that slows down consumption on the global level, which can slow down economic growth and business investment. So that is a real risk. So I know that, yeah, that's a little bit of where you're going with that. Thanks, Barry. Yes, yes, please.
Thank you very much for your enlightening talk. I'm very much sold and convinced that Trump cannot be as harmful today as it could have been before, okay, especially for places like in Latin America or developing world. So I absolutely partake your view on that. But I just had a little bit of concern on the political side of this. I would be more convinced if your talk had been presented, let's say, a few years ago, especially thinking that some of the key actors, and I'm thinking of more state actors here, in today's world, are more on the page of Trump rather than on the page of proposing this alternative. I mean, namely, the BRICS alternatives, right, that have been emerging in the last 20 years. Today, some of these countries are in the hands of governments, such as in Brazil, India, or even in China, in hands of officers, of administrations that partake much of the view of the Trump administration, which is not to be so willing to rebuild in favor of multilateral action. So how would you add that more political side to this in terms of what you see in the next few years?
Sure, it's a really good question. It's certainly the case that the BRICS group I think can accurately be characterized as a kind of unhappy marriage. It was a slightly happier marriage, as you rightly note, before illiberal nationalist leaders emerged in some of the BRICS countries. But having said that, given that there have been political changes in countries, yes, like Brazil is kind of case in point, the BRICS group nevertheless stays together as a kind of unhappy marriage, as a counterweight against other countries. And so despite the fact that there is less coherence in the worldview of the BRICS group now than there had been a few years ago, they have launched, nevertheless, some initiatives that are at least indicative of a kind of pragmatic or a strategic need to stay together when it comes to just some specific things, like responding to U.S. financial or trade sanctions. And I think so that's kept some of the leaders working together such that they continue to meet on the sidelines of the Group of 20 summits and continue to work together on a couple of initiatives like the creation of a BRICS-level credit rating industry, a BRICS-level alternative to SWIFT, a BRICS-level alternative to what's called CHIPS, which is yet a kind of another piece of the kind of veins of the global financial system. It's another payment transfer system. So there is still some instrumental objective that keeps these countries together when it comes to cooperating in the realm of finance, but not, as you say, in other realms, to be sure. But having said that, I do want to say that this is not just a story about the BRICS, because I do agree with you, and indeed when I started writing my book several years ago, everybody was talking about the BRICS, and now the BRICS are, it's a bigger group, and indeed there's a kind of cottage industry among people that study international economic relations in terms of coming up with new acronyms, the MINT group, just for example, which is to say that is the set of rising powers bigger than Brazil, Russia, India, China, and South Africa? The answer is obviously yes. Indonesia, Turkey, South Korea, Chile, Colombia, Mexico, Nigeria are also countries that we might think of just as examples of other rising powers that are also kind of part of this story of incoherence. And I know in the interest of time, I didn't have time to provide more examples than I could, but there are actually other initiatives that involve a much larger set of emerging powers that have different interests, and some of which there are governments that are much more committed to democracy than in other cases right now. And so that's, I think, part of the kind of messier landscape that's emerging. And indeed, I should say some of those countries that are not part of the BRICS group have also become much more influential at the IMF and the World Bank and have kind of pushed their agendas. They've also been part of joining some of the Chinese-led initiatives and have been developing some of their own initiatives. And I'd say in particular, I think what's interesting in that domain is Islamic finance. Islamic finance is a very kind of heterogeneous alternative financial model that is structured somewhat differently in different countries within the Islamic world, but it's becoming a very rapidly growing part of the global financial system. And I think it's also part of the way in which the financial system of today looks very different, such that you have financial systems governed by kind of Western principles and also some that are guided by religious principles as well. So that's also part of the heterogeneity. So thank you. Good point.
Everybody join me in thanking our speaker today. This is wonderful. Thank you, Eileen.
Oh, thank you.
Thank you
all.
so much.
Thank you. Thank you.
Thank you,
Thanks.
everybody, for
Thanks.
coming.
Thank you, Chris.
We'll see you next spring.
Great.